We came into this eyes wide open on demand. In fact, JPMorgan was one of the most bearish house on the street on demand growth. We don't assume recovery to Jan 1 level these years until the end of next year at around 98 to 100 million barrels is the forecast into Q4. So what we're seeing now is essentially a revision of expectations for this year, which are clearly hurting the front end on the spot price. But as you look beyond this year and look at the direction of travel, particularly with China and India and some of the larger continents coming back fast, we do see that the only thing holding back demand growth will be the rebound in the US. As the rebound in the US occurs, that should be sufficient to start to see inventories come down. But meanwhile, you have supply, the sort of race to the bottom coming off literally by week, we're seeing data points on more supply revisions downward, which clearly tells you that something next year in terms of a tightness is what we should be focusing on.
If I have a tech company or a .com or a cloud company that says I'm going to do X in 10 years' time, everyone's biting and trying to desperately get involved. But I think you're making an interesting point here. Correct me if I'm wrong, but you're talking about the energy transition here, and I know you've got a note out on BP today saying it remains a spectator sport, plenty of interest, but no one's biting, i.e. no one's buying into the transformation story.
Absolutely. In fact, I think the issue we have with these stocks is that they're essentially moving their strategy into a different direction. We still can't get comfortable with their own bread and butter business, oil, which is still volatile. Then to say that they're going to move into low carbon, it's a lot more than you can process. But I think the flip side to this is look at the valuations. You know, BP 6% yield while you wait, with a focus on delivery on returns. They got fantastic oil beta. The one data point that I would say I think the market's missed through this restructuring revision in the last few quarters is cash break-evens. BP's cash break-even pre-dividend is less than $20, post-dividend at $40. That basically means that if oil's at 50, 60, 70, whatever it is next year, you have so much free cash flow that can be recycled back into the capital frame, can be rewarded in terms of dividend or buyback, and ultimately be used as well to fund the low carbon strategy. So this is not a strategy with no reward behind it. And on a risk reward basis, we got 60% upside to BP, which tells you that it's commensurate with the kind of risk associated with this strategy shift.
Yeah, Christyan, I wanted to refer to that. So it's nice that you finished on that. With the company around 254p, your 425 pence price target for the end of this year does seem quite ambitious. There needs to be a bit of wake up and smell the coffee moment among investors, doesn't there, to get that degree of movement before we wrap up 2020?
Totally. I think the price target was on a 12-month view, so we are looking to deliver that sort of around this time next year, not the end of this year. But you're absolutely right, Jeff. The actual issue here is that investors are looking at this and saying, well, why bother? Why should I get involved now? I can just watch this and get onto the journey at some point when I've seen delivery of returns on a low carbon strategy. Everyone's so worried that they're going to go in and buy stuff at very expensive valuations. Equally, oil price, there's no catalyst. So if you're buying this for beta, well, if oil prices aren't going to move until next year, I can afford to wait. And that you're seeing that through the valuation, seeing that through the yield. So at this point, you're kind of the share price is arguably pricing in maximum uncertainty. But when you sort of stack up what they've delivered through their volume growth and some, you look at the metrics, cash break-even valuation, everything suggesting that having restructured, they've got a great line of sight now on the business they want to keep. And as they build out and de-risk the low carbon strategy, that's where you'll see the re-rating into next year. And I think investors at the moment are pushing back on the payout. There's no dividend increase, but when you put the dividend of 20 billion plus a buyback of 13, you're around 50% of the market cap is what's rewarded back over the next 5 years. So it's essentially shrinking the business through this strategy, which gives them even more beta to oil in the process. And people have always said, we want you to shrink to grow. Well, that's exactly what BP's doing and being radical about it.